What you're about to hear isn't speculation, and it isn't a warning about something that might happen someday. It's a breakdown of what is already unfolding right now inside the U.S. housing market, largely out of public view. While headlines focus on mortgage rates, affordability, or whether the average homeowner can still qualify for a loan, a far larger story is quietly developing behind the scenes. A story involving Wall Street, pension money, leverage, and a $2 trillion institutional bet on American housing that is now starting to come apart in real time. Over the past several weeks, new housing data has begun to confirm what many institutional analysts have been watching for months. According to Zillow's most recent nationwide update, more than half of U.S. homes are now losing value year over year, 53% of homes to be precise. That is the highest share since 2012, when the country was still digging out of the last housing collapse. This isn't a localized slowdown or a seasonal adjustment. It's a broad shift in price direction, and it matters because of who owns a growing share of these homes. During the pandemic years of 2020 through 2022, Wall Street made an unprecedented move into single-family housing. Flush with cheap capital and driven by models that assumed permanent demand and rising rents, institutional investors poured money into residential real estate at a scale never seen before. Private equity firms, publicly traded real estate investment trusts, pension-backed funds, and large asset managers bought entire neighborhoods, often competing directly with individual families. They paid aggressively, routinely offering 20 to 30% above asking price, because the math appeared to work as long as prices and rents kept rising. At the peak of this buying frenzy, institutional investors purchased well over 300,000 single-family homes. The average price paid during 2021 and 2022 was roughly $420,000 per property. Today, Zillow's current estimates put the average value of those same homes closer to $365,000. That's a decline of roughly $55,000 per home before accounting for property taxes, insurance, maintenance, financing costs, or management expenses. Multiply that loss across hundreds of thousands of properties, and you're already looking at tens of billions of dollars in equity erosion. But this story doesn't stop at price declines. The real risk lies in how these purchases were financed. Institutional buyers did not simply deploy cash. Many of them borrowed heavily, leveraging existing portfolios to acquire more homes. Loan-to-value ratios of 70 to 80% were common. When housing values fall 10 to 15% under that kind of leverage, equity cushions evaporate quickly. Debt covenants tighten. Refinancing becomes more expensive. What Wall Street calls margin compression sets in, and the pressure begins to build from multiple directions at once. We are now seeing tangible signs of that pressure. In recent months, several large institutional landlords have acknowledged valuation headwinds in earnings disclosures. Acquisition programs have been paused or quietly shelved. Lending institutions have begun tightening credit terms. Rating agencies have placed certain real estate vehicles on negative outlook, citing weakening fundamentals in key markets. These are not abstract risks. These are operational responses to deteriorating asset performance. What makes this situation even more significant is the source of much of the capital behind these housing bets. According to public filings, major pension funds allocated billions of dollars to residential real estate strategies during the pandemic. Retirement systems representing teachers, public employees, and other workers were funneled into housing through private equity partnerships and real estate funds. As of late 2025, some of these real estate allocations are now reporting negative returns for the first time since the aftermath of the last financial crisis. And unlike stocks, housing is illiquid. Losses cannot be exited quickly without consequences. Zillow's regional data reveals an even more troubling pattern. The markets experiencing the steepest declines today are the same markets where institutional buying was most concentrated. Florida, Texas, Arizona, Georgia, and North Carolina were the darlings of pandemic-era housing models. These states are now leading the country in year-over-year price declines and rising inventory. In Florida, condo prices have fallen sharply, but single-family homes are also sliding. In Texas, especially in metros like Austin, valuations have retraced dramatically from their peak. Phoenix, Tampa, Charlotte, and parts of Georgia show similar trends. At the metro level, the numbers are staggering. Thousands of homes purchased at peak prices are now worth tens of thousands less per unit. In some regions, that translates into hundreds of millions of dollars in lost equity concentrated in a single metropolitan area. When this pattern repeats across multiple institutional-heavy markets, the losses become systemic rather than isolated. Unlike individual homeowners, institutional investors cannot simply wait indefinitely for a recovery. They have shareholders, lenders, and fiduciary obligations. When asset values decline and financing conditions tighten, they are forced to act. That action usually takes the form of portfolio optimization, geographic rebalancing, or asset sales. In plain language, that means selling properties into a weakening market. This is one of the reasons inventory has been rising so noticeably in recent months. According to national listing data, active inventory is now significantly higher year over year, reaching levels not seen since before the pandemic. In markets with heavy institutional ownership, inventory is well above historical norms. Meanwhile, markets with minimal institutional participation are holding up far better. This divergence is not accidental. It reflects where forced selling pressure is beginning to emerge. The financial implications extend far beyond housing alone. Institutional exposure to residential real estate is embedded in a web of financial instruments, including real estate investment trusts, mortgage-backed securities, structured credit products, and pension allocations. Federal Reserve data shows that total institutional exposure to residential real estate now exceeds $2 trillion. When derivatives and secondary instruments tied to housing are included, the exposure grows even larger. This raises an unavoidable comparison to 2008, though the mechanics are different. The last housing crisis was driven by household leverage and poor underwriting. This cycle is driven by institutional leverage and capital misallocation. The risk is not widespread homeowner default, but coordinated institutional repositioning in an illiquid market. When institutions move, they move in size, and their actions reshape markets quickly. Despite this, optimistic forecasts continue to circulate, predicting a rebound in housing by the middle of the decade. But history suggests that when asset bubbles unwind under leverage, recovery is rarely swift. The process is slow, uneven, and psychologically draining. Prices grind lower. Confidence erodes gradually. Capital exits quietly rather than all at once. This is how prolonged corrections unfold. For individual buyers and observers, the coming phase will be defined by opportunity, but only for those who understand what's happening beneath the headlines. Institutional sellers behave differently than individual sellers. They are not emotional. They are not waiting for the perfect price. They are managing balance sheets, risk limits, and timelines. That creates negotiation dynamics that simply didn't exist during the frenzy years. The most compelling opportunities are likely to emerge where institutional exposure is highest and financial pressure is greatest. Suburban growth corridors, outer ring metros, areas that experience the fastest appreciation and the heaviest institutional buying. These are the markets where price discovery is still underway and where discounts are likely to deepen as portfolios are unwound. This leads to a broader geopolitical question that rarely enters housing discussions. What happens when U.S. housing becomes a financial pressure point for global capital? Over the past decade, American real estate has increasingly functioned as a store of value not just for domestic investors, but for global capital-seeking dollar-denominated assets. As geopolitical tensions rise and global capital becomes more selective, confidence shifts. When capital retreats, asset bubbles deflate. What we may be witnessing now is not just a housing correction, but a repricing of U.S. assets in a more fragmented global financial system. The answer is uncomfortable, but necessary. When speculative capital exits, markets revert toward fundamentals. Housing transitions away from being a leveraged financial instrument and back toward shelter and utility. That transition is painful for institutions positioned on the wrong side of the trade, but stabilizing over the long term. We are still early in this process. The data makes that clear. Prices are adjusting, inventory is rising, and institutional behavior is changing. The assumption of permanent appreciation is fading. What replaces it will shape housing, wealth, and opportunity for the next decade. If this analysis helped you see the housing market differently, subscribe to the channel to stay ahead of the shifts that matter. Understanding what Wall Street is doing before it becomes obvious is how long-term advantage is built. The institutional unwind has begun. The only question is whether you'll recognize the opportunity when it finally becomes visible to everyone else.